Well, welcome everyone. It's a pleasure to have you here with us. My name is Irene Kelly, and I'm the Financial Education Program Manager at WEV. Today, I'm very excited for this session because we have a very special guest, and I'm going to introduce her in a moment. Before we jump to that, I want to acknowledge anyone that is new to WEV. Welcome. If you don't know a lot about WEVE, let me tell you a little bit. We are a nonprofit organization serving entrepreneurs in Santa Barbara and Ventura counties with programs delivered both in English and Spanish. And we've been doing this for 29 years. Although we focus on serving local entrepreneurs now with the ability that we have to meet you through our online services, we can expand our reach. So we're very excited wherever you are at. Welcome. A big part of what we do here at WEAV is that we provide business training, coaching, business advice, and very importantly, we provide business loans. So today we're going to be talking about how can we manage and understand our debt, not only during COVID, but beyond COVID, right? So if COVID is teaching us something, is how important it is for us to be organized and to be conscious of the state of our finances at all times so that we're prepared for anything that comes our way. So without further ado, I want to introduce you to our guest today. Her name is Marnie Brook, and Marnie is the Director of Lending here at WEAV. Marnie, how are you?
I'm great. Thank you for having me.
Oh, my pleasure. So today, I would like to take a moment to acknowledge that we are here for you. So I would like to just take a moment to use a chat and think about what brought you here today. What made you sign up for this webinar? What made you say, I want to commit some of my precious time for this topic? If you feel comfortable, please just write down in the chat, what is it that you want to take out of today's session so that we can tailor your needs today. And you can do it at any time, right? Also, if you have any questions, feel free to use our chat, use Q&A at any time. We don't have to wait till the end to address your questions. For business owners, debt can be a very powerful tool or a huge obstacle. So that's why we are going to divide our conversation today into 4 different areas. And these 4 areas are basically going to be the objectives that we have, the goals that we have for the session is first to understand how credit works, right? When I think of debt, I like to think of it as like now that I'm watching Queen's Gambit on Netflix, I'm like, it's a game. Like imagine this is chess, right? How are we going to play chess if we don't know the rules of the game? The same applies to debt. First, we're going to understand how credit works so we understand the rules of the game. Then we're going to proceed to talk about our debt and how our debt works. After that, we want to be able to provide you with the right tools for you to get a debt management strategy going. And finally, we're going to talk about how we can use debt as a tool. And Marnie's going to be coming in and out in the conversation, but she's going to be particularly helpful when we're talking about how can we use debt as a tool, especially within our businesses. And let me just review the chat real quick. Okay, so we have some questions about particular business loans, PPP, IDL. So for this session, we're going to keep it very kind of broad, again, like rules of the game, right? So that when we go to specifics, when we think about particular business loans, we know exactly what we have to be aware of, so that even navigating those loans would become a little easier. And we're also going to provide our information in case we don't cover the specifics. We can connect outside of the webinar to go over your specific questions because we do have that ability. Okay, so thank you for being here. So let's get started here. One thing that I would like to invite you to do before we jump in is think about from 1 to 10. 1 being least confident, 10 being most confident. How confident do you feel with your ability to manage your debt? And it's very important to do these check-ins. Every time we're learning more about finances, take a moment to do these checkings because it's important to celebrate our progress, right? These, our aspect, the financial journey aspect, it's not a sprint, it's a marathon, right? So we're running together here, folks. So just take a moment and acknowledge that, because we're going to go back to that question at the end of our session. And our hope is that that number goes up, up, up. So let's officially begin by talking a little bit about the rules of the game, right? How credit works. Basically, when we're talking about credit, we're really trying to understand the environment, right? The credit and the debt landscape, so that we can be more proactive and we can be more objective when we think of debt. There is no magic tool to pay off our debt, right? But it is possible to have an advantage if we know the rules of the game. So when we're talking about credit, what we're truly referring to is how much money we can borrow. And this amount of money that we can borrow is based on our ability to manage debt and to manage our finances. So as we were mentioning earlier, our credit can be a very powerful tool or a very good, big obstacle in order to achieve our financial goals. So a responsible use of our credit is going to demand that we are organized and that we are regularly monitoring our budget and expenses. When we hear credit profile, when we hear, okay, we need to look at your credit, here we're talking about two major aspects: our credit score and our credit profile. So let's jump in and talk about our credit score. Our credit score is basically a 3-digit score. It's also known as our FICO score. This way of measuring our ability to manage debt was designed in 1928, and it was created to streamline and simplify the process that lenders, like Marnie here with us, that lenders use to review people's ability to manage debt and pay back potential loans. So the range goes from 300 to 850. There are also credit scores that are business related, but what we have noticed is the personal credit score, it's very, very important. Sometimes it's, and please correct me if I'm wrong, Marnie, that is looked at first. Sometimes business credit score might not be as paid attention to.
Many lenders don't even consider the business credit score. So it is the personal credit score, you're absolutely right, is far and away the most important.
Perfect. So when we're looking at our score, one thing that I want to say right away is please be compassionate with yourself, because sometimes we look at these scores and we're like, oh my God, like that is terrible. But don't let those numbers affect the way you feel about your ability to manage that. Those numbers are just there to point at what we can do to improve our ability to manage that. So best rates are considered above 740. If you're 740 and above, you're going to get very good interest rates and very high quality loans. When we are under the 620 number, that's when we are considered higher risk. So there, our ability to get good interest rates or higher quality loans is going to be very limited. So, but the good news is that we can improve our credit score. Mm-hmm. And by how do we do that? Well, first, going back to that game analogy, we got to understand what it's accounted for, right? When it comes to our credit score and the factors that they measure. So there are 4 major factors. First one is on-time payments. I can't say it enough how important it is to make your payments on time, because unfortunately our credit scores are very sensitive and they're quicker to come down than to come up, unfortunately. So if you pay your debt on time, you're already on route. Mm-hmm. Then the second aspect that we should be aware of is how much of our credit we utilize. If we look at percentages, mm-hmm, our payment history, what we were just talking about, accounts for 35% of the score. Like that's one of the highest components, right? Payment history and making on-time payments. 30% of our score is based on how much of our credit we utilize. It's always better to have a higher credit limit and not use it all than to have less amount of cards, but we're almost at the max, right? So always make sure that you have room to wiggle. Mhm. Then the other component, when we're thinking about the length of our credit history, that accounts for 15% of our score. Mhm. So that it's important to start early, but be very responsible when we start, right? Almost like you have your first credit card. It's decoration. I call them that. It should be decoration because the interest rate is going to be very high. So you just use it for something and pay it right away, so that you start building slowly and surely that length of your credit history. The other component, 10% of our FICO score, is a credit mix, right? What type of loans do we have? And we're going to talk a little bit about that in a moment. And also searches for credit, right? That's an important piece, because sometimes we hear a lot of myths and a lot of statements of, oh, if you're shopping, your credit score is going to be affected. And that's really not the case, because it all depends on that time frame in which we are applying for a different card or a different loan. When we are shopping and we're receiving a lot of inquiries from lenders in regards to our credit score, that is not going to affect our credit score. But if we're constantly searching and constantly shopping for different products, that is when we might have our credit score affected. I don't know, Marnie, if you have in this aspect, if you've seen something that might be helpful for our audience to know about searches for credit. What should we be careful with?
Well, first of all, a lender can't pull credit on somebody that's just inquiring about rates and terms. If you're just truly shopping around to understand what your options are, that would not impact your credit. It's the point at which you apply. The lender must be authorized to pull your credit report. And so that's where you want to be really careful, is understanding where you are in the process and knowing that, again, the point at which your inquiry becomes an application, that's when credit gets pulled. And each time your credit gets pulled, it does impact your score, particularly if there is sort of a rapid succession of inquiries on your credit. And it's unfortunate, because in many cases people think, they just want to understand their options and know the best thing available to them. And then as a result, if they aren't careful with that distinction, that can actually impact their credit. And I was going to just make a suggestion too, with regard to your first bullet point, which is so important, as you mentioned. And that is that, of course, everybody wants to get themselves to a point where they can pay off their card in full every month. And that's a wonderful goal. But at very least, if you do start using your revolving credit and your credit cards, to set up those automatic payments on or before the due date of at least the minimum amount, and maybe slightly higher than that, because those minimums are typically fairly small unless you have had to use a lot of your credit. And it's just, as you point out, it's so impactful, and it's something you can set up that can truly make a huge impact on your credit. So that's sort of an actionable item. And then I was just going to mention, with regard to the utilization, the second bullet point, that if you owe more than 50% of your total credit lines, that's when scores start to get impacted, and where lenders start to have greater concern about your credit utilization. So just as a general benchmark, to illustrate your point.
Perfect. Thank you. And remember, we're recording this webinar because we're going to, as Marnie's saying, a lot of little tips here and there. So make notes, and also remember that we're going to record it so that you come back to it. So we're getting into that territory of improving our credit score, right? We started learning how can we do so. So just to summarize some of these points is pay your debt on time, right? Marnie said it, automate your payments so we don't forget, right? Let's embrace technology. Let's make our lives easier, automating those payments. Keeping our credit balances low, right? Marnie just said less than 50%, please, because otherwise that credit score is very, very sensitive. So we have to be aware of that. avoiding unnecessary borrowing. We're going to touch on this later as well, right? If we're going to get in debt, let's make it count, right? Let's get into good debt, into that debt that it's a tool, that it's an investment in our future, right? And finally, monitoring our credit regularly. I cannot tell you how many times I've heard of people that they never monitored their credit. They were very responsible, and next thing you know, there was fraudulent activity that they had no idea about. And that's why it's important to monitor our credit regularly. Or I've also heard stories of people that with with your cable box, if you
I
don't
was just going to
return
say
it,
that same thing. Yeah.
and they send you to collections. I'm like, what? That is horrible. And you might not even be aware of. And the only place to know what's happening is through our credit report, right? So that's where we're heading next. So once we cover our credit score and these very important items, we start getting into the territory of our credit report. Our credit score is part of our credit report, right? Think about of our credit report as the story of how we've been managing credit, and it's a very objective story, right? It's not like a novel we're reading. It's very objective. It has all the pointers of this is exactly what this person has been doing, and this is how this person has been managing debt. This credit report is tracked by three different credit bureaus: Equifax, Experian, and TransUnion. We are entitled to request one report per year for each of these organizations. So technically, we're entitled to request 3 reports per year. What we recommend is request them, spread out those requests. Maybe January, you do one of the credit bureaus, May, another one, September, another one, particularly if you're a business owner, right? Particularly. So this is just important for us to know because we are entitled to these reports. And if we plan it, that we spread it, then we can be much more on top of our finances and monitor them regularly. And catch any fraudulent activity or any things like the cable box thing that you can be sent to collections and you don't even know it, right? So that would be in terms of our credit report. Once we start understanding, right? Okay, so I need to be aware of my credit report. I need to be aware of my credit score. The next big item for us to be aware of and ask questions about is interest rate, right? When we're thinking about interest rates, we're referring to the amount charged on top of the principal, right, by the lender to a borrower, meaning us, for the use of the money. So think about the cost of the loan, right? Because that money that we're receiving, that money could have gone to someone else. So that money has a cost. The fact that we're borrowing that money has a cost, and that's the interest rate. As we were mentioning earlier, if you have a good credit score, if you have a positive history managing debt, we would be considered low risk, a low risk borrower. So that can lend itself to lower interest rates and lower risk loans. Whereas when we think high risk loans basically are those loans where we don't have the credit scores that we hope, and our numbers are looking a little low. We're considered a high risk borrower. And it makes sense. This is not something for us to be like, oh my God, that's a horrible thing. No, it's just what it is. And if we work responsibly and we're determined, we can improve that credit score. We're just gonna have to be very conscious and shop around for loans that have better interest rates for us, that accommodate to our situation. Another very important thing to know is that generally we can see 2 different types of interest rates. Simple interest rate, where we say, we come in, they say, okay, 4.5% is the rate of your loan. So you're going to borrow X amount and 4.5, and that's it, right? We're not going to charge you anything else. Those are the preferred interest rates. But then we also have, I like to call them dangerous, a dangerous rate, which is compound interest. Compound interest, it's a very expensive interest rate because it, as the name says, it compounds each term of your loan or of your debt. So when we think about credit cards, for example, sometimes That interest rate that we have, if they say 4.5 is your interest rate, but it's a compound interest rate, what it means is that every term, at the end of the term, that 4.5% interest is going to be charged not only to our principal, but all the interest that we owe. So it ends up being much more expensive, and it ends up being much more than the 4.5% that a simple interest would have. So always ask before getting into debt, always ask what type of interest rate is, so that we don't end up paying more for something that we don't want to pay more. And just when we hear annual percent rate, like a lot of mortgages, for example, it's just important to know that they generally do not use compound interest, thankfully. So just FYI. So once we ask about our interest rates, once we know, okay, these are the interest rates that I'm carrying, or this is the interest rate of this new loan that I'm applying for, now we start getting all the bigger scope of the picture. So the next item that is going to be important for us to understand is what type of loans are out there for us to take advantage of. And I like to divide them into four different categories in terms of personal loans, business loans. And they can be more than two categories, as we're going to see in a minute. So the first type of debt that we want to talk about is secure debt. Secure debt is usually we can access lower interest rates because this debt is backed by a physical item, also called collateral, right? An example is our car loan or our mortgage. This is a loan where it's secure because if we don't pay it, or if we don't have the ability to pay, the lender can say, okay, then give me back the physical item, right? So that's one type of debt to be aware of. Then the second type, it's unsecured debt that is not backed by a physical item. And sometimes that's when we start seeing the interest rates coming up, because it's a higher risk for the lender, right? They don't have anything to use in case a person doesn't pay, right? An example of these types of loans are student loans, medical bills, all of these items that are not backed by collateral or a physical item. Then we also have revolving debt. Revolving debt is basically an open line of credit. We can have a business line of credit. When in the personal side, our credit cards are like this, where we have this credit limit, and we can come in and take debt as we wish, right? There's a lot of flexibility in revolving debt, which requires a lot of responsibility, because we can get excited and we can say, oh yeah, no, I have money. But we have to remember that this is not our money, right? This is not our money, not because it's there and we can take it as we wish, means that that's our money. So we have to be very conscious of revolving debt. We also have non-revolving debt, right? Those loans that are meant for a specific amount and a time deadline. And once we use that amount, there's no more money, right? Mortgages are examples of those type of debt, right? And we can see one loan could apply into two categories. Like our mortgage could be secure debt, but it's also non-revolving debt, right? So when we have, going back to what we were talking about, our credit score, if we have more than one type of debt, that also helps us build our credit score, because that shows that we have the ability to manage different types of loans. So this is really where we start getting all the rules of our game, right? We know now the basics of how to play chess, going back to our game analogy. So the next step, it's really start navigating our debt, right? And for this component, and please, if there are any questions, feel free to use the chat at any point. Now, when we're talking about understanding our debt, right? So we have the ground rules of the game. Now let's start getting into our game, right? Really, here is where we have to be very conscious that there's a lot of feelings when we think of debt, and especially when it's our debt. And this process can become a little bit overwhelming and complex. So it's going to be important to be patient with ourselves as we review our debt, as we manage our debt. And here, the first step, I really like to start just right with the uncomfortable part of our numbers, right? let's just go through them. One thing that I've seen in this aspect when we're talking about debt is the concept of facing our debt, right? Here I would like to just let's take a moment to think about how do we feel when it comes to, okay, how are you? How's your debt? And acknowledge that a lot of people, there some mixed emotions come up, right? A lot of fear comes up, a lot of anxiety comes up. So we just have to acknowledge that. And here is where I think psychology can be very, very helpful, because psychologists have this term when it comes to dealing with fear and dealing with anxiety, this term that I've grown to love, called name it to tame it. It's easier to deal with something when we just take it out in the open, right? It's okay. Let's acknowledge it, and let's learn. Let's get some tools so that we can face those complex issues and those complex feelings around that. When we're talking about facing our numbers really means facing our financial present and facing it from a perspective of objectiveness. Before working at WEV, I worked as a financial advisor. And I have to tell you, I know that a lot of people, the moment you say numbers, are like, But let me tell you, if we flip that mindset, numbers can be such a powerful tool, because numbers don't lie, right? Numbers are so objective, and numbers can really help us paint a story, a very objective story in an area that can be so complex and so overwhelming. Numbers can truly become that anchor that help us navigate this topic a little better. It's just a matter of facing the numbers and remembering that we are in control of those numbers at the end of the day, not the other way around, right? We just have to have the patience and the determination to use the numbers to our advantage. In this area, I'm going to recommend that we always start with your personal, right? Face your personal finances so that it becomes a little easier to face your business finances. And when we face our personal finances first, it's a smaller, right? It's a smaller task. So we practice there, and then we get the confidence we need to then face our business numbers. So I would encourage you to do that, but at the end of the day, you have to find what works for you. That's just a suggestion. Now, what tools are we going to utilize when it comes to facing our numbers? Two very powerful tools. One, our budget. Second, our balance sheet. Let's talk about budget. Even if you don't like the word budget, I recommend you to change it, right? Call your spending plan, right? Words matter. So just change the name if you're like budget and you're cringing. That's normal, right? That's absolutely normal. Let's just change the name so that we can take control over these tools. What to look for when we're identifying our budget? So basically, a budget is going to have our income and expenses, money coming in, money coming out. When it comes to our income in relation to our debt, we have to think about, is my income enough to cover my expenses? Is my income enough to cover all of my debt payments? That's going to be the first item for us to look for. If in this exercise we identify that it is not enough, right, or I'm looking very tight, we have to think about what's under my control. And if I don't have the ability right now to either diversify my income or increase amount of sales, then we have to look at our expenses. And in regards to my expenses, this is when we have to start identifying, are there any expenses that you could be letting go of to be able to allocate more money to pay off your debt? In this exercise, we can always find something that is not absolutely necessary in our budget. A good example is sometimes when we have been paying a gym membership that we do not use, then maybe this is the time to say goodbye to that membership and work out at home and channel that money to our debt, right? And many examples, or subscriptions. Sometimes if we actually sit down and look at our statements, we can find expenses that we forgot that were taking place. So that's why it's important to give the time, give your financial life the time and energy, and sit down and navigate your expenses. Identify, I'm not using this subscription. Bye, let go. It's very healthy. It's very important, especially going back to the time we're living in, right? COVID is really teaching us how important it is for us to be flexible and to be organized so that we can be much more resilient. So be on top of your expenses and identify what can we let go of. The next very powerful tool when it comes to facing our numbers, it's going to be our balance sheet. Our balance sheet is really going to say, okay, what do we owe versus what do we own? Mhm. And if we start with what we own, it's just important to have on top of mind what type of assets do we own. And if we don't have a lot in that list, this is a good moment to think about what do you want to own, right? Because this is going to be the driver of your financial journey and your financial goals. What type of assets do you want to own? Mhm. And making that list is very helpful because then we can identify, oh, if an emergency was to happen, I know that I have these assets that I can sell or move around with, be flexible. So it's important to understand the assets that you own and the ones that you want to own. The second component, and then we're really getting into our debt, is liabilities, right? Debt. So here is basically identifying how much debt do we have in a very, very objective way, like letting the numbers tell us a story, letting the numbers tell us, okay, this is what we have to manage responsibly. And here is where we start diving a little deeper into the specifics of that debt, right? Could our debt be considered an investing in our future? Because that debt is basically going to become an asset. So that's why it's important to understand that that debt is not going to be there forever. And that debt, it's also touching into the asset territory, which is very exciting. And lastly, understanding how is our debt being managed and what can we change to manage it more efficiently and in a way that make us truly feel in control of our finances and in control of our debt, not the other way around. So in regards to the debt that we can consider and investing in our future, this is where I like to think about good debt versus bad debt. Mhm. Good debt is that type of debt that it's an investment in our financial future. It's debt that we spend on needs rather than wants, right? Good examples here are our mortgage, student debt. Mhm. If we need a vehicle for work, that's good debt, right? That's an investment for us to be able to work and be able to generate. So those are good examples of good debt. Mhm. Then we have the other side of the coin, bad debt. Okay. And this again, let's think about it from the perspective of I want you to use these tools as if you were your financial advisor. When you're going through your numbers, we have to remain objective. If you start feeling like, oh, I know, I'm identifying a lot of bad debt, come back to the objective mindset, to the objective hat, and think, okay, I'm identifying bad debt. Let's see which ones so that we start learning from that. Mhm. So bad debt would be considered that debt that we use for wants rather than needs, right? Things that don't represent an investment in our financial future, right? Also, this includes debt that we had an emergency, we really didn't put the time and the effort to shop around, and we end up with very high interest rate loans, compound interest, those loans that are really an obstacle for our financial future. Those would be considered bad debt. That's why we have to be very cautious before getting into debt. What am I getting into, right? Truly do that research so that we don't fall into bad debt without knowing that it's bad debt. Mhm. Once we have more clarity about our current debt, we can identify the aspects of it that don't necessarily meet the eye, but have a big impact on how we manage our debt. Here is where I like to take a take a pause. And as you can tell, we take a lot of pauses because this is a complex topic. So it's important to take it with patience and with compassion because all there's no perfect financial journey, right? We're all learning together, we're all in this together. So this is a good moment to be very objective with ourselves and very just conscious of, if we identify bad debt, we need to take action, right? If we identify bad debt, let's really take a moment to think about why do I have bad debt? Where is this coming from? And what am I going to do so that that doesn't happen again? So to do that, we're going to use our model to simplify our finances. And there's another webinar that we've given in the past. If you feel like you want to know more about this particular subject, and you can find that in our website. But for this regard, when we're talking about simplifying our finances, here is where, if we identify something negative within our finances, we have to think about, where is this coming from, so that I can attack the root of the issue. So sometimes these issues can come from 4 places, right? First, our financial past. So in regards to debt, this is a good moment to ask yourself, how was debt managed when you were growing up? What lessons did you absorb around debt growing up? Because those items matter. We don't think about it, but they're in the back of our head all the time, and they matter. So we have to acknowledge them so that we learn from them. So that is one area in which we can find the roots of some of our issues, or as I like to call them, areas of opportunity. Then our financial present, right? Our financial present could be, do I understand right now my biggest priorities? Am I spending my money according to my priorities right now? Am I struggling to accept my financial present? Because unfortunately, right now, our financial present has been heavily affected by outside circumstances that were completely out of our control. So this is a moment for us to refocus on what's within my control, especially when it comes to our financial present. Then we have our financial future, right? In regards to our financial future, it's important to have that clarity of, where do we want to go with our finances? If we don't know where we're going, it's like a trip, right? We're talking about financial journey. If we don't know where we're going, we're going to get lost. We're going to waste a lot of resources. If we're going on a trip, we're going to waste a lot of gas. We're going to deviate from the journey. And we lose a lot of very valuable time and energy in that, not knowing at least the direction where I want to go, right? So financial future, it's important because we need to identify, where do we want to go? How are we going to get there? And how are we going to prepare for challenges along the way? And this touches in strategy, right? When it comes to strategy, if we don't have one, that's challenge number 1. So identifying, do I have a plan in place, right? And understanding that strategy, that plan, it's going to change, right? It adapts to our life, it adapts to our present. So just making sure that we are aware of these 4 items can be very, very powerful. Because let me tell you, from a previous experience, I saw clients that would come in with very healthy budgets. They'd had the income to get to where they wanted to get. They had a wonderful plan. But one big challenge is, if you don't have the habits and the mindset to get to where you want, that beautiful strategy is in vain. So that leads me to a very important topic that I just want to touch on today with you, which is our mindset and our habits, especially when it comes to managing debt. If we want to manage debt in a way that it's healthful, in a way that it's responsible, in a way that it's not a burden, but it's a strategy, right? We're empowered and we really take control of our finances, and our debt is part of that. Our mindset has to be in alignment with that goal. So our mindset is basically our thoughts and beliefs around money. So one good way to identify if our mindset is in alignment with what we want for our finances is to ask ourselves, what fears and feelings towards debt do you have? Or also touching with financial past, what fears and feelings towards debt did you absorb growing up? Because if we have particular fears around debt, those fears can limit our way to manage debt, and they can also limit the way in which we apply for future debt, right? The way in which we think of debt as a tool or not as a tool, right? So our mindset is important to check in with our mindset. And our mindset is really that aspect that make us feel anxious, overwhelmed, right? Stressed, or also can make us feel excited about our financial journey, empowered about our financial journey. So if you identify that your mindset is more on the no, I don't I don't like what I'm seeing side, don't worry, you're not alone. Let's start getting you to the other side of the spectrum, because that's where we should be. Money is a tool and we are in control of that tool. So let's keep getting some of these new resources and tools so that we can be more proactive in that regard. The second aspect that I wanted to touch here is financial habits. It's like that experience I was telling you a little earlier. I saw so many people that in paper they had everything they need, everything they needed to get to their financial goals. But if they don't have the habits, they're just not going to get there, right? I wish I could tell you there's magical options here to get to where we want to get, but that's not true, right? This requires work. This requires determination. Our financial habits are those behaviors and conducts that sometimes we do unconsciously. That's why they're so tricky. That's why we have to be so aware of what are those things I'm doing, good and bad, and which ones can I start tweaking to get to a more responsible management of our finances and our debt. So here I would like to invite you to ask yourself, what financial habits do we need to manage our debt effectively? Two very big ones in here. I would love, Marnie, if you have more, please pitch in. Paying on time, which we've been talking about, not overspending, right? Don't spend what you don't have, okay? Unless it's an investment in your future, right? What other things can you think about, Marnie, in regards to that?
I think you've covered it, but the word that always comes to my mind when I think about debt and all of these topics that you're discussing is discipline. Which sounds like that's a word sometimes people, sort of like you said before, the word budget or whatever, that might not be a word that people love to hear, but it really kind of summarizes everything that we're saying, which is, and also I love what you said before about being kind to yourself and realizing, in many cases, like right now, if we were to all sit here and look at our credit report or look at our, credit card statements, that can feel scary, but those decisions have already been made. And really, it's so disempowering to not face what already is, and is so conversely empowering just to say, yep, that's what it is. And by setting these disciplines and just taking charge, creating a strategy, paying on time, not overspending in the future, making better choices and learning, from our prior decisions is really just the goal. Like it can get better is the point. I know right now in this current environment, that might be challenging, more challenging for people to imagine, but thinking about these kinds of things and employing these sorts of disciplines will make a huge difference in helping you feel in control, like you said, in control of this. So I don't have anything other than that to add, but.
I love what you said, Marnie, about the past is a past, folks. We can't fix it. It happened. But how important it is to acknowledge it, right? And now be disciplined. And now let's move forward, not backwards. Let's move forward. Don't waste your precious energy and time on things that are already not in our control. They happened. So once we are aware of that and once we accept and move on, that's when great things start happening, right? So I love that. Thank you so much for that. So once now we have that picture of what are those factors that affect our debt that we have to be aware of. So now that we have the full picture, right? The financial past, the present, the future, the strategy, the mindset, the habits. Once we start understanding all of those, this is when we start getting into how are we going to strategize in regards to paying off our debt or in regards to managing our debt efficiently. And Marnie touched on a very important word, discipline, right? So I love this quote because I think it's so relevant to managing debt, right? Where the determination is, the way can be found. If you want to manage your debt more efficiently, you can, right? It's just a matter of truly being determined, not giving up. We have to be patient because sometimes, depending on how much debt we're managing, it's going to be a slow process. But if we're determined, we can do it, right? And remember, you're not alone in this journey. So the fact that you're here today, I want to take a moment to acknowledge that you're here today, because that just shows that you have determination and that you are on the right path. So congratulations, because seriously, you keep going, you keep going. We're here for you, and we're very proud of you for taking these steps, because this is exactly what we need to do, right? Keep learning and get the tools we need. So when it comes to our debt management strategy, here we're going to start identifying the steps, right? Because it's really all about steps. First step, and we touched on it when we were going through facing our numbers. Let's list everything we owe, every single thing. Let's identify all our minimum payments and all of our interest rates. So that we can then, especially in regards to our minimum payments, let's identify how those fit in our budget. So let's review our budget and make sure that all of those minimum payments are incorporated in our budget, right? They're priorities in regards to our expenses. So let's make sure that they are there, they're part of our budget. Then that's when we can identify what's the best payment plan for us, especially when we have additional money there that we found because we were effective and we let go of some things that no longer serve us. Let's say we found a little bit of more money per month that we can put towards our debt. That's when we have a couple of options in regards to our payment plans. So here, I'm going to introduce you to two different options, right, in terms of my debt payment plan. Assuming that, and I'm going to repeat this, right, because sometimes repeating things help us really kind of, okay, connecting. They say that we have to repeat something like 7 times. I don't know how many times for it to really click. Yeah, 7 times. So budget for all minimum payments, right, so that our credit score is not affected. Very important. Second, find that additional amount that we can allocate towards our debt. And there's going to be 2 ways, right? We can prioritize debt with the highest interest rate. And I'm going to give an example in a little bit. That's also called the avalanche effect. Or we can also prioritize the smallest accounts. That's also called the snowball effect. Once the first, like a domino effect, once the first item in that list is paid off, we're not going to use that money and go party. No, we're going to use that money, that amount, to roll it over to the second amount in the list, the second item. So that second item becomes the first item. And that's how we're going to go, right? Very disciplined, one after the other, until we don't have any items in the list, okay? And here, for this 4th item, we want to have more webinars in especially around those topics. But for now, we're just going to touch on that area. Here, there's also the opportunity to consolidate debt. Once you're identifying all of those items, that's the opportunity comes in where we can consolidate, right? Especially if we find for credit card debt, for example, when we have an opportunity to have a less interest rate, a card with a smaller interest rate, we can use it to consolidate more expensive debt. Another item could be refinance, especially for bigger items. If we have a good credit score, if things are looking better than when we first got a bigger loan, the refinancing might be a good alternative as well in terms of our debt payment plan. So remember that there are always options. There are always options. But going back to the 2 examples of debt payment plans, I'm going to present you with examples. So let's say that, okay, I already made my list of how much I owe, interest rates. If we choose the avalanche strategy, what we would do is we would prioritize the higher interest rate items. The reason why I like that strategy is because it's the most cost effective, right? We're paying the most expensive items first, so that is going to be cheaper. However, this does not take into account the amounts of debt. For some people, that psychology is important, right? So for some people that are like, it's just stressing me to see the smaller items there just swimming in my list. I just want to pay the small items first. That moment is where we can consider the snowball strategy, where we start with the smaller items in terms of how much money we owe, regardless of the interest rate. That works for people that are just stressed about seeing those little ticket items, right? And I've seen people that also combine, right? Like they choose the avalanche strategy, and when they receive some additional money that they were not anticipating, and that can cover a full credit card that has just been there waiting to be paid, they can do it. At the end of the day, the best method, and this is very, very important, the best method is the one that you can stick to, right? So I can tell you, okay, I love avalanche strategy because it's more cost effective. But if that doesn't motivate you, if that doesn't feel right for you, then that's not the method for you. Okay, so here just pick the method that you like more. If you're a person that needs more motivation to pay off debt, the snowball strategy might be very helpful. And here, one helpful thing to do is also use specialized debt repayment calculators to discover when you're going to pay off your debt. If that's something that it's important to you to know, if that's something that's going to motivate you, I'm going to provide a website where you can find a very, very cool debt payment calculator. If that's not something that you're particularly interested about, just stick to your plan. Don't worry about when it's going to be paid off, as long as you stick to the strategy. Mm-hmm. So this leads me to resources, right? If I can sum a couple of very important aspects for us to know about, is first, we have to stay organized, okay? Because at the end of the day, and thank you, Jerry, we'll send you the recording. Thank you so much for coming today. And you have a great Thanksgiving as well. Yes, you guys, Thanksgiving is approaching. So we're particularly thankful that you're taking some of your precious time to be here with us. So staying organized, right? We've been noticing this is a complex topic. There's a lot of moving pieces, and there is technology that we can embrace to help us in this process. So some recommendations is first, for personal finances, some people like the software Mint. It can be very helpful to navigate our debt a little easier. Another aspect we like, especially for business owners, is QuickBooks. QuickBooks is a very powerful tool that can truly help us navigate our finances a little easier and also manage them, because it can help us also automate processes. So to stay organized, it's going to be very important to understand automation, the power of automating to reduce our financial stress, because there's less items that we have to worry about. Mm-hmm. And very important too, regular financial reviews. Very important. At least once a month, you should sit down and look at all of your numbers, right? Make sure that everything that's happening, it's correct, that everything that's happening, it's under your control. So regular financial reviews are key. Then the second item in terms of important resources for us to think about is, you're not alone in this process, especially when you're a business owner. You should be working with a team. You should be finding the right professionals to help you get to where you want to get. Mm-hmm. It's very important for us to understand the basics, right? Like what we're doing today. Now, going back to the game analogy, it's very important to know how playing chess works so that we can play efficiently. But we don't have to do everything ourselves, right? We can partner with other people that know how to play the game a little better, and they help us out. So for these areas where we can consider partnering with different people, like a bookkeeper, right? Someone that is responsible for recording transactions for us and helping us in that regard, and someone that can help us get reports on a monthly, quarterly, annual basis. Also, financial coaches or advisors that can help us stay accountable and that can help us look at our full financial picture. Debt counselors, right? Very important to consider. If we're carrying a lot of debt counselors can be particularly helpful. One thing that we want to recommend is, don't go with the first person you meet, right? Because it's like any industry, There's people that are going to be caring for you, like for you, and there's people that are going to be caring for them first. So always take the time, interview these professionals. We have the rule of three. I think that's a great way to just find three people and ask them, right? You are the client. You should not rest until you find people that understand you, people that are honest, people that really give you the time that you deserve. So take the time to find the team that works for you. Another aspect of this team could be trusted contacts, accountability partners, especially when we talk about personal debt, our family, our partners, right? That's where we can really help motivate each other to pay off our debt, right? If we really take the time to say, hey, this is my goal, I'm struggling with this, where are you at? And we can help each other out along the way. So find accountability partners because they can be very powerful, right? Because then you feel that pressure of, I said that I was going to do that, I need to, they're going to ask me, right? So that can be very, very helpful. Never underestimate the value of accountability partners and friends. And then the last item in regards to our debt management plan and strategy is keep learning, right? Again, this is a marathon, not a sprint. Okay. So here we added 3 books that we really like that touch on some of the aspects that we've been talking about, especially in regards to mindset. We love the books that we're showing you here today. And there's so much more. We're happy to, anytime you're like, I'm looking for this type of resource, send us an email, reach out, because we're happy to share more. And as I promised, the webpage nerdwallet.com. You can find a really cool debt repayment calculator there that I really like. And you can also find comparison tables for different credit cards and different debt products. That it's important for us to be in control enough and empowered enough to compare products, right? Ask questions. So these tools can be very, very helpful in that regard. So now we truly covered how credit works, right? Rules of the game, how our debt works, how to identify where we are in terms of debt. And we also started talking about our debt management strategy or our debt management plan. So now that we have the biggest pieces, we can start talking about how do we use debt as a tool, right? Once we're organized with our existing debt, we can truly start thinking about the role of debt in our future, in our lives, and really start thinking about debt differently, right? Really start thinking about debt as a tool that is going to help us achieve our dreams and aspirations. So before I pass the microphone to Marnie, I want to leave you with this 4 items, right? If we want to use that as a tool, it's going to be very important to come back to that concept of our finances as a whole. So learn from our financial past, adapt our debt to our present needs and priorities because they are always changing. So make sure that your debt is aligned with those needs and priorities. Then, in order for us to use debt as a tool, it's going to be important to align that debt with what we want for our financial future so that it becomes a tool to get us there, right? It's going to push us toward that direction versus pushing us back. And finally, stay accountable to ourselves and others. That's very, very important. And here, one example to how do we stay accountable to ourselves, I want you to go back to that first question I asked you at the beginning. From 1 to 10, how confident do you feel with your ability to manage your debt? 1 being least confident, 10 being most confident. That number that came up, I hope that there was a difference. And if there was not a difference, that's okay, right? Because again, this is a process, this is a journey. But that exercise is one way in which we can stay accountable to ourselves because we're always trying to improve. We're always trying to feel more confident, more in control. That's really the ultimate goal. And particularly when it comes to our businesses, it's going to be very, very important to understand as well, what are my options, right? What are the rules of the game when it comes to using debt for our businesses? So here I would like to hear from Marnie and what she has seen. Marnie, what have you seen in terms of debt and how powerful it can be for businesses?
Well, thanks, Irene. And I want to go back to one of the, not literally, but verbally go back to one of the slides, the earlier slides about good debt versus bad debt. And the idea that particularly where your business is concerned, that debt, while many people, assign very negative kind of connotation to that, they don't want to be in debt. They don't want to owe. And I absolutely respect and understand that. But I often try to maybe repurpose that conversation a little bit with our applicants and our clients to think about money. In this case, it might be somebody else's, but as a means by which they can achieve their dreams and goals for their business. Because without it, it's still possible to do those things, to be sure. With it, though, it can be a powerful tool to accelerate you on your path to doing those things, and to perhaps smooth that path a little bit for you as well. Because as we know, cash flow for small business owners is one of the toughest things to manage. And debt, if used for the purposes intended, and with the correct application of discipline with regard to using that money, can help you grow your business and is an investment in the future of your business. And so thought about that way, we really want to change the conversation around debt. And so that's one way to think about it. And I appreciate you bringing this, putting this quote up on the screen here. This is one of our great WEV loan clients who talks about her experience working with WEV on a loan. And I think this is meaningful because many people don't even want to engage in the process because it is a sensitive topic. It's something that people have, in some cases, they have some guilt around it, or maybe they even have some shame about it, about the decisions that they've made in the past that might show up on their credit report. Or the fact that when they do provide their balance sheet, maybe it doesn't look the way that they might want it to look. And so I like what Raina says here, that we took the time to break things down and look at it on a personal level and really hear the story around it. Because as Irene also said before, your credit report and your financial statements and your balance sheet are all part of your story. And we want to hear it. We want to know it. We're going to look closely at it so that we can try to understand it. So all that is to say also, before I talk about a little bit about what lenders look at, may I just reassure you all, we have seen it all. We have seen everything. So in no way should what you have to present be a deterrent for you, because you know what your story is, and we want you to tell it to us so that we can try to help you get what you need. So I always want to say that too, like, don't worry, we love you anyway. So don't let that be a deterrent for you in, again, achieving what you need. So maybe we'll move to the next slide from there. And briefly, I'm just going to run through this because we've already sort of talked about these things. But again, knowledge is power, right? So if you do decide that you want to apply for a loan to invest in your business, to invest in that new product, to invest in building out your website, to invest in a new location or in improving the one that you have, a loan can be a really powerful way for you to access that capital. Again, assuming you find a decent rate and decent terms, and only pay it back in small increments over time. So these can be very powerful things. So a lender will look for, WEV is an economic development lender, but I was in banking for 23 years. So it's the same. It's really, lenders are looking for the same things. And so this is what we look for. Number one, this is true, is your credit score and your credit report activity. WEV is a lender that will look beyond the score at the actual story, and we can have a little bit more flexibility. In many cases, banks are unable, because of the programs they subscribe to and everything else, that they are unable to get past the score if it doesn't meet their minimum requirements. Irene already talked about what those basically are. So just know that, and know that if your score falls below what is considered to be somewhat unbankable or unlendable, you can fix that. There are ways that you can improve that. So don't let that deter you either. Taking one step, taking one action can improve that 1 to 10 scale that Irene talked about before. And so that's, anyway, I'm sure she'll probably close with something like that. So credit report and score, very important. Lenders want to look at your past ability to generate profit, or hopefully not loss, from your tax returns and your financial statements for your business. So they're going to look at that. And again, in some cases, if the past numbers don't look that great, it might be difficult to get traditional loans, but don't let that deter you either, because if you have a great plan for what you are going to do with your business, lenders like WEV and others want to know those stories too. So we look at that. We will look at the amount of existing debt that you have, both business and personal. Sometimes people do have just a bit too much debt. Again, you can fix that. Based on those plans that Irene talked about, you can start taking actionable steps to reduce the amount of debt that you have with the discipline, that we already talked about. So, but that is an important factor for sure. The lenders will look for personal and business assets. So again, those are things like cash you have in the bank, savings accounts, investment accounts, maybe inventory if your business has inventory, real estate, vehicles, equipment, all of those things. And they will look to see if you have accumulated at least some personal wealth or assets. And then they're going to look for a business plan. And this, from my perspective, is one of the most important things. If you want to borrow money and you want to invest in your business, what is your plan? What are you going to do from here? And that's really the gist of a business plan. It can get very fancy or it can be very simple. And so those are the things I think that you need to be prepared to provide. And the more prepared you can be, and these are things also I just really want to encourage you, if you are thinking about getting a loan or you have an offer from a bank or another lender, that WEV can be a place for you to come and say, hey, can you help me to either get prepared, or can you look at this offer that I have? Do you think this makes sense? Is this okay? And because we are a nonprofit economic development agency, we are not incentivized to tell you no, come, get a loan with us if we think it's a good loan, if we think it's a good deal. And that can give you more confidence in terms of accessing that loan as well, because somebody that understands credit said, yes, this looks very straightforward. This is a good deal. So I want to encourage anyone that was watching this now or later to feel free to reach out to us. That is a service we are happy to provide. We don't want to see anybody getting into bad debt, as Irene pointed out before. It's much harder to get out of. I always liken it, I forgot what example you used, to gaining weight. You can gain like 10 pounds by eating one piece of cheesecake, and then it takes like 4 months to take it off, It's like, making better decisions and is always a better way to kind of to start. So anyway, these are the 5 things that I think are most important. You can be empowered to apply for a loan if you feel that you have access to all of these things and are in control of all of these things. And if you don't feel, call us, and we can help you to get into a better place with these things.
Amen. I'm like, amen.
Yeah.
And especially, I would like to point out that if you have a challenge in regards to business plan, within WEVE, we have programs and
Yes.
training sessions where we can help you get your business plan up and running. So don't let any of these items be a deterrent, because we have different services that we can connect you with to get you prepared, right? So if there's something missing, just tell us, hey, I don't have this. How can I get it prepared? Because we literally have services to get you prepared for all of these items.
Yeah. People have different pain points, don't they? In terms of areas of comfort and confidence and all of that. And I guess I keep saying it, but I'll say, whenever you reach a pain point and you you're there, don't let it deter you. Don't let that deter you, because we can help you to try to get past that and get empowered with knowledge and documents and all these things, instead of feeling, you know, disempowered by those things, for lack of a better term.
Amen. So, Marnie, could you tell us a little bit about, like, let's say someone is watching this and they're like, I want to get a loan with WEV. Like, what types of loans do I have access to? Could you tell us a little
I think
more?
we have a slide. Yep, if you want to move there. Yep. And this is all on our website too. I noticed on this, on our little slide sheet, I think it's at the end though, that we don't have our website. We keep referring to our website, but we don't have it there. I know it's at the end though, but
I'm going to post it in the chat, and it's also going to be at the end.
At the end, yes. So WEV has 3 basic loan programs here, which are listed. We do make loans for individuals that want to start a business. And that's not hard, that's not easy to find. There are very few lenders that will make an investment in a startup business because there's no history, you know, to help them make a decision. But we do. And we consider a startup a business that either hasn't started or has been in business less than 12 months. We make up to $25,000 in loans to those business owners. And you can see there for what purposes, you know, basically to invest in, again, either the startup or ramp up of a brand new business there. And then we also make loans to businesses that, much larger loans to businesses that have been around for more than 12 months. So they do have a little bit of history, and we can see that and make a larger loan decision based on that. So we make loans for expansion for up to $150,000. And then you can again see the purposes are generally the same. These are all term loans. You can have up to 7 years to repay those loans. And also, unlike a lot of other lenders, we can be really flexible with regard to how we set up payments. That's a conversation between us and our borrowers and our clients in terms of what they think they can do right away. And maybe we can be a little more flexible with them at the beginning of the loan to help them get to a point where they can implement all these wonderful things and start making money. And then we do have a loan that we've created as a result of this particular COVID crisis. And that's called our Restart Loan. And those are also up to $25,000. And these are for businesses that have been impacted by COVID and need to invest back in their business, to pivot their business model, to identify new income opportunities for their business, refresh their website, some of these things that are listed there. And these are also term loans. They're up to 5 years. We do offer interest-only payments for the first 6 months. And this loan does have a lower rate than our other loan programs because, again, it is designed for businesses that have been severely impacted by this pandemic crisis. So these are the loans that we have available now. And again, I just really want to encourage anyone that does see this to, if they have questions or they just want to know the process. How long does it take? What would my payments be? What are my chances? Call us. We have those kinds of conversations all the time with people. Call us or email us, whatever you're comfortable with. And we'd be happy to have those conversations with you. This is my team. This is the gals, me and the gals. This is
the dream team.
Yes, myself, the dream team. And on my right, your left, if you're looking at this, Marta Quintero, my bilingual loan officer who's located in Santa Barbara, but serves Santa Barbara and Ventura counties, and Stephanie Martinez, our fabulous administrative assistant for the loan program. And we are small, but we're mighty.
Yes,
There's 3 of us, but we're a great team. And these ladies, if you ever have questions they are the most friendly, accessible, easy to talk to people you could ever find. So that's us, and that's my contact information there. And you absolutely are free to call me or contact me directly.
Thank you so much, Marnie, for your time today, for all these valuable resources. We want to just take a moment for any questions that are lingering there. This is a good time to go through them. If not, it always happens that the question comes in hours later. You're like, oh, so please, as Marnie said, feel free to reach out directly to Marnie or myself. One question that I've got from before, and you touched on a lot of those aspects, would be, what are the qualities needed to manage debt effectively in your opinion, Marnie? Yeah, I know you touched on discipline, but I want to know if anything else comes in.
Well, I mean, I don't know about qualities. Yeah, I guess just a commitment, which is I think maybe saying the same thing as discipline, but maybe not. Like a commitment to to a commitment to your plan and your strategy, and maybe a vision for what that's going to feel like and look like at the end. What it's going to feel like. I just really quickly
Yeah.
saw the most wonderful post from one of our clients yesterday on Facebook, who celebrated with this long, lengthy post and even a little video of her walking up to our office in Santa Barbara with her payoff check for her WEV loan. And it was so unfortunate, because of course we're all at home, so there was nobody there to receive it and jump up and down with her and celebrate that exciting moment. But she really talked about how important that was. And you could really feel like just how good she felt about that. And so I think that's knowing how good it feels to get in control of this aspect of your life, to not let it control you, to not be disempowered by choices you've already made. And to just, like, I love how you said before that you just look at it, you look it in the eye,
Yeah.
and you start making choices and taking actions that set you on a good path. And then I just want to also say that debt is a wonderful thing to want to get out of when it's bad and it feels like a burden. But debt is also a very important tool for you, particularly for your business, when you have a dream and you have a plan, and in order to implement it, you need money. And a good loan at a good rate with good terms can help you get there much quicker and in control.
Mic drop. I'm like, yes.
Word.
Yes, 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 because I love how we talked about vision, because we didn't talk a lot about that. But for me, it's such an important step to get to that healthy financial journey.
Yep.
We have to literally, like, close your eyes, imagine yourself in that moment where you're like, that would look like financial success for me, because everybody has a different definition of financial success. So find your definition by taking the time to envision, right? Because that vision ultimately, we saw, right, this requires that commitment, that discipline. So if we don't have that vision to motivate us, it's tricky. It becomes a chore rather than an empowering journey. So I love that you brought that up, Marnie. Thank you so much, because that vision is essential. I almost like to reverse engineer when we work with our clients in terms of simplifying their finances. Start with the vision, because it's going to be much easier to face the numbers and navigate everything when you know where you're going.
That's true. Right? And look at them with compassion, like you said too, that be compassionate.
Yes. Yes, and feel free, please, to reach out to us if you have any questions, or if you want to be part of more of our webinars and our programs. We're here for you. Marnie, do you have any last words?
I don't. I think you've covered it all so well, and thank you for having me.
No, thank you for your time. It's a pleasure having you here. To close, I just want to invite all of you to some of our webinars that are coming up. We have, to close the year with splendor and organization, we have a webinar called Avoiding Common Year-End Accounting Mistakes Using QuickBooks. So this is particularly important for our business owners out there. This is going to be taught by our WEV QuickBooks coach, David Mahacek, and it's going to be on December the 10th from 6 to 8 p.m. I'm going to post the link to register if you want to. You can also register through our website. I had it right here on the screen. And we also have a QuickBooks coaching program. When it comes to getting everything organized, you're not alone. You can partner with one of our QuickBooks coaches to start slowly but surely taking control of your numbers. So that's all for us today. And we're again very, very thankful that you're here with us. and that you took the time to go through this and get the resources that you need to take control of your finances. So thank you again for being here with us today, and have a wonderful rest of your day.